Okay, hi guys, it's Ian Coleman from Trader Management Company. I'm going to discuss, not in great detail, but in detail, the Elliott Wave principle. Now, during a lot of my trading or analysis, you'll either hear me talk about Fibonacci levels, wave sequences, targets, projections, retracements, impulsive waves, corrective waves. Now, these are all made up through the Fibonacci sequences that are used in the Elliott Wave formation. Some traders, especially traders that are a bit old in the tooth, believe that the Elliott Wave sequence is a bit of hocus pocus. Some trade to it religiously. There is actually a website called Elliott Wave International that just purely concentrates on wave sequences, but I think it's the principle of Elliott Wave that you need to be aware of, and not worry too much about some of the complicated sequences that can occur, i.e. we'll talk about it in a bit, but the corrective waves can be complex, what they call complex waves. So you try and basically break down the wave pattern to predict where we're going to retrace to, or where we're going to extend to. And a lot of the time, the retracement wave sequence, which is normally an ABC sequence, can become very complicated. And Elliott Wave theorists use this complication, if you like, to add new waves on X, Y, Z, etc. But a lot of the time, if you've got a reasonable knowledge of other chart formations, i.e. if you've got a reasonable knowledge of wedges and as such, then you can normally sort of pick your way through it. Okay, I don't trade religiously to Elliott Wave because, firstly, well, for some of the reasons I've already explained, and secondly, the waves can get thrown out. You also need to look at the big picture and break it down into smaller wave patterns within the big picture. But as we're going to see soon, if you have what you think is a bullish formation, then you can use Elliott Wave and in particular the Fibonacci numbers to try and work out your best entry and exit level, and that's what we're going to discuss today. So what I'm going to do, I'm just going to zoom in on this number sequence here. Okay, hopefully just looking at my other screen to try and make it perfect. Don't know if I'm going to be able to do it on that. Let's see. So this is what I basically want to discuss, this sequence here. Okay, this is the Fibonacci sequence. Okay, it was an Italian mathematician who basically noted this reoccurrence in life of this number sequence. So, okay, so it's 0 plus 1 equals 1, 1 plus 1 equals 2, 2 plus 3 equals 5. Okay, so you're just adding the numbers together, the previous number with the present number, and this becomes the Elliott Wave sequence. Now, the numbers that are used most in trading are what they call the golden ratio. Okay, let's just get back onto there. So the golden ratio, and the golden ratio is basically one number divided by another number in the sequence, and then that number reversed and divided by each other. So here, let's just take these two last numbers. So we've got 89 divided by 144, okay, and that equals 0.618, okay, and that's what's known as the golden ratio. So that's the most important number to remember when we get on to Elliott Wave and the sequences. So 0.618. So basically, if you take any number in the sequence, it could be going into thousands and thousands and thousands, and you divide them by each other, you'll get 0.618. Okay, And also, which is important to note, if you take 144 and you divide it by 89, then you get 1.618. Okay, and this is the wave projection that is used in Elliott Wave. Okay, so let's just drop that down, and then I'm going to explain how we can use this in our trading. Now, don't ask me how it or why it occurs, but the market has a tendency to move to these wave projections. Okay, so when we can actually decide for which is the first wave, we can then look for Elliott Wave projections or Fibonacci projections to target these next wave sequences. Okay, so let's just drop this down. I'm just going to expand out again. And we're going to go back to this one from Friday. Okay, I'm just going to delete these guys because this is the retracement. Did a report earlier on, so that was just on the retracement. So okay, let's get back to basics. Daily chart. We want to trade impulsive moves, and by impulsive we're looking for sharp price action. Okay, and here you can quite plainly see that this price action is sharp. Okay, so Euro Aussie rallied sharply from the 2nd of August all the way up to the 9th of August, and then we've had this corrective or consolidating wave, okay, that's come down. Now, as I said earlier, if you've got a half decent knowledge of chart formations, okay, you'll probably note this to be a potential flag formation, so, or a pendant. Okay, so we move up, this causes our flag or our flagpole, and this is then our flag. I mean, we can put some lines on it just very roughly, just to show what we're talking about. Okay, so this is the flagpole, and this is the flag, and then we're looking for a breakout. So as this retraces down, we're then looking for bullish signals to try and get a long trade, okay, to take us higher, to cause the other flagpole, because what the flag dictates is that you have the flagpole, you then consolidate, it then breaks out, and the next rally is the length of this flagpole. Okay, and that's over, I think it was 1,300 points, that rally. So risk reward, extremely good. Doesn't really want to be missed. Okay, so we go down to 4 hours, and this is how I do a lot of my analysis. So I'm breaking it down through time frames. So I then take it down to 4 hours. Okay, I'm just going to get rid of the flag. Okay, and then I'm looking for signals on this 4-hour chart of a possible base. Okay, and for that I want reversal candles. Okay, so here we can see there's no reversal candles until we get this here. Now that is an outside bullish engulfing green. Okay, and that has basically signaled the base of this corrective wave down. Okay, so then breaking it down into 1 hour chart, we can clearly see that 4 hour candle is here, okay, forming the start of wave 2. Okay, actually truly goes bullish here. So after that, let's just get the time, 18th of August, 5 o'clock. So go back to 4 hour chart. Okay, so that's 18th of August at 1 o'clock, so that candle finished at 5 o'clock. So that bullish candle finished at 5 o'clock on the 18th of August. Just expand it out. So at 5 o'clock it finished there. Now at that point we actually get an inside, what they call an inside Arami candle, but it then breaks through this resistance level with a bullish green. Note where the RSI is at that point. The RSI has then turned positive, so that's giving positive breakout to the upside. It's at that point that we want to be looking for the Elliott Wave sequence. Okay. Also, okay, with regards to Elliott Wave and Fibonacci numbers, this move up was impulsive, which we've talked about already. This move down was corrective, and it was also in 3 waves. So we get one wave up, impulsive, move down, corrective, 3. Next wave up, impulsive. Now this wave 2 to 3 should be the most impulsive of all the waves, the strongest of all the waves. Okay, inside red, which shows us that we're probably making an interim top for the time being. Note that it also hits the trend line of the flag. Okay, we then pull lower, spikes down towards support, cause us to have wave 4. We'll break this down into short time frames just to see whether or not this was in 3 waves as well in a minute. Okay, and then a rally up, and this is our 5th sequence, our finishing sequence. Always going to be the choppiest of the waves. So how can we predict the turning points for these different waves? We use our Fibonacci tool on our chart package. Might look slightly different on yours. Okay, and then you place it at the beginning of what? Of the base. Now, how do you know when the wave sequence has started? I mean, that's a good question that we should cover anyway, because we get a higher low. Okay, markets in a downtrend, we get lower highs and lower lows. In an uptrend, we get higher highs and higher lows. And here we've got a higher low. Okay, so we then place our Fibonacci tool, and then we pull it up to wave 1. Okay, and we want it to read 100% at wave 1. We then click it onto the chart, and it should be set. Now, Elliott Wave dictates that we have wave 1. We then have a second wave, a retracement wave, a corrective wave that should correct between 50 and 61.8%. So this one overshot slightly. We then move up, okay, in the third wave, wave 2 to 3, towards 161.8%. The retracement is then down in 4, okay, and then a rally up in 5 to 261.8%. Now, I also said earlier that I wasn't an Elliott Wave follower, a strict Elliott Wave follower, should I say. And the reason behind that is because Elliott Wave theorists would actually say that this count is invalidated, because this 4th wave, this corrective wave, let's just see the low of this candle. This low of this candle is 137.23, and the high of this candle is 137.25. So there's only 2 points in it, but Elliott Wave, true Elliott Wave theorists would say that's an invalidated count, because the rules are that wave 3 to 4 can't move past the peak of wave 1. Okay, we then have 5th wave up, 261.8%, and then a 3-wave correction. Now, it's debatable at the moment whether or not the 3-wave correction is here, 1, 2, 3, and then a rally up, or whether or not this is going to be 1, 2, and then 3. I'm actually edging on the side of a further correction down to here before the next wave up. But the risk potential, the risk reward potential now is extremely good. Remember, we've got this big flag that we're looking at, okay, and we're looking to ride that flag up. The reason why I think that we're probably going to get a retracement lower as well is, one, the time scale. It's taken quite a few hours to form 5 waves and not very long to form 3 waves, and also this would be wave 3 higher, so this should be impulsive off the base. This should have rallied up, and it hasn't, and we've actually got an inside red here from late on Friday, so I think we'll probably get a correction lower, but looking towards 137.40-30 area would be a fantastic area to go long. The stop would be back inside the channel, and we could get a decent rally up. Okay, but just going back to Elliott Wave, So you have these sequences, but you also have sequences within the sequences. So this was 3 waves. If you notice here, we've got 5 waves inside of this impulsive 2-3. 1, 2, 3, 4, 5. Okay, and here 1, 2, 3, 4, 5. So the impulse waves, which are 0 to 1, 2 to 3 and 4 to 5, should be made up of 5 waves, internal 5 waves. Corrective waves, as in all chart formations really, should be made up of 3 waves. And that is one of the reasons why this area is extremely hard to chart and forecast, because Elliott Wave says that wave A, or the corrective wave A, can be made up of 3 or 5 waves. Corrective wave B should really only be in 3 waves, and corrective wave C can be in 3 or 5 waves. So, as I said, it does get very, very complicated. You can also get extensions of those waves, but what we are looking for, okay, is projections, target levels, and that's why just combining these Fibonacci extensions and retracements can be very, very beneficial for our trading indeed. One thing I should note, obviously Friday we took a long in this pair, but we got stopped out flat, is all this time that she's in this impulsive, once this wave 1-2 has been confirmed, all the time that she's in this impulsive sequence, just note where the RSI is. Okay, it's virtually all, apart from here where it just spiked through, virtually always above 50. Okay guys, I hope that makes things a little bit clearer when you are in the room when I'm talking about Elliott Wave, or I think this is an impulsive 3rd or an impulsive 5th, or we're in a corrective sequence. Hopefully you'll understand what I'm talking about. As I've said, I don't stick strictly to the rules, but what I am looking for is impulse waves, and you'll hear me talk a lot of the time as well about the fact that I don't want to trade what I think are corrective sequences. Okay, I hope to speak to you soon. Cheers.